Okay, in this final video on ratios and financial statement analysis, we're going to take a look at the Dupont analysis. It's a way of breaking up the return on equity and return on assets into some constituent parts and get a little bit better idea on how the firm is performing and actually see some of the levers that affect financial performance. So return on assets, it's defined as net income divided by total assets, but we can decompose that into a couple of different pieces. And those pieces are net income over sales multiplied by sales over total assets. So we have the product of two different ratios gives us the return on assets. And in particular, those ratios are the profit margin. So net income over sales is the profit margin. And sales over total assets is the total asset turnover. So what we have here at the bottom is that return on assets are a function of the profitability of the firm and the asset management, the efficiency of the firm in using the assets that they have. So return on assets can go up basically by two different measures or in two different ways. If we increase the profitability, if we can control expenses and get more profit out of every dollar of sales, that's going to boost return on assets. Or if we can get more out of our assets, if we can boost the sales from a given set of assets, then we can also increase the return on assets. So that's the decomposition of return on assets. We can also decompose return on equity. So the definition a few slides back was net income over total equity. We can break that up into three pieces. Net income over sales, again the profit margin, multiplied by sales over total assets, that's the total asset turnover. And then we have a third ratio here, the equity multiplier, which is defined as the total assets over total equity. And if we have these now three different measures, we can kind of focus in on any of the three to boost the return on equity. If we increase the profit margin, our return on equity will go up, everything else being equal. If we're more efficient in getting sales out of assets, then our TATO will go up. That will boost return on equity, everything else being equal. And then this third lever, the equity multiplier, basically tells us that if we use more debt and hold everything else constant, our return on equity will actually increase. And so with this Dupont analysis, we can see the different drivers, the different levers that managers can use to boost the measures. Now, it's important to note here that all return on equity increases are not created equal. That is to say, one firm may increase their return on equity by boosting the profit margin. That's a great way to do it, right? If you can get more profits out of every dollar of sales, if you can control costs, if you can do things more efficiently and reduce the cost, then your profit margin will go up and the return on equity can go up. Another firm may boost their return on equity solely by taking on more debt. That's a very risky proposition, and you can hopefully see that that would be a less desirable way to boost the return on equity. So just because two firms have the same return on equity, or if they both increase the return on equity, doesn't necessarily tell us all that we would like to know. And this Dupont analysis is a nice way to kind of dig in and see what's driving the performance. There's an extended Dupont analysis where we decompose it a little bit differently, a little bit more. And so now we have 5 different pieces that we're looking at. The first being net income over pre-tax profit. This is called the tax burden ratio. If we multiply that times pre-tax profit over EBIT, that's also called the interest burden ratio. And then we multiply that by the operating profit margin, the total asset turnover, and the equity multiplier as before. We get, again, the return on equity. And we just have these 3 new little pieces here, these 3 new ratios. The tax burden ratio shows how the firm is affected by taxes. So tax policy changes would show up here. And of course, taxes are partly a function of government policy, but also a function of how the company handles that policy, what kind of actions they take to mitigate the taxes that are due. It may come down to how the firm recognizes or how they estimate bad debt, for instance, or how they depreciate assets, how they handle inventory, LIFO versus FIFO, etc. So the firm does have some impact on how the taxes that they pay. The interest burden ratio shows how much the firm is paying in interest, and so it's a function of the debt that the firm is taking on as well as the interest rate on that debt. So the higher the interest burden, the lower that pre-tax profit will be compared to EBIT, and the lower the return on equity will be. And then finally, the operating profit margin. I think we've actually looked at that on a previous slide, but that's how much operating profit versus net profit that the firm earns on each dollar of sales. So the higher the operating profit margin, everything else being equal, the higher the return on equity will be. And then the other ratios, TATO and Equity Multiplier, are as they were before. That's the Dupont analysis. And in wrapping up, let's take a look at this very last slide. There's a few really important things to keep in mind with ratio analysis. And I think I've mentioned some of these before, but a ratio by itself means next to nothing. It really needs some context to make some sense. And so we're always going to be looking for a benchmark of some sort. That may be the firm's past performance. So if we look at prior years and see how performance is changing over time, that gives us a little bit of context. That gives us some sense of if things are improving or deteriorating. We might also want to look at firms in the same industry, competing firms, and see how our firm stacks up. So we've got a benchmark of another firm. And it's very important to point out that it's in the same industry. We don't want to compare ourselves to a completely different firm in a completely different industry. We might be a very young firm, a new firm, and it would be completely inappropriate to compare yourself to a very mature firm in a completely different industry, because the numbers, the relationships are going to be completely different. One firm, one industry may be very asset intensive, and so it's going to have relatively low total asset turnover, for instance, pretty low return on assets. Whereas another industry may be very knowledge intensive, and it's all about the people. It's not really about manufacturing plants and that sort of thing. So it's critical that benchmarks are appropriate and comparable. And so with a firm over time, we'd want to look at it that way, or with competing firms in the same industry. And again, this first point, I think I've mentioned a few times, that there's never really one measure that will capture everything, but we want to look at several things together to get a holistic picture of the firm and its performance over time. And with a particular ratio, there is no one right number. We generally will have a desirable range. And again, that's a function of the industry. It's a function of the company where we'd want to be. Firms that are kind of boom bust, they're in that sort of cycle. They may want to have a lot of liquidity, a very high liquidity ratio. They may want to have a lot of cash and near cash things to get them through the tough times. Whereas firms in a very stable industry, it wouldn't make sense. It would be a waste to have a very high liquidity ratios and liquidity measures, because they're going to have a lot of assets that aren't performing, that aren't functioning well for the company, being productive, and that's going to hurt their performance. So with these kind of rules in mind, rules of thumb in mind, we can use ratios as a tool to help us as managers maybe highlight things we want to look at. If we're investors, ratios can highlight possible investments, possible exciting opportunities, or on the flip side, ratio analysis might highlight things we want to avoid. It may highlight firms that we want to avoid. If there's some potential problems looming, ratio analysis may draw focus onto those problems, and we can avoid that. If we're a supplier, if we're a customer, ratios might help us in making our decisions as to who we're going to buy from, who we're going to sell to, etc. So ratios are a very handy thing in financial management.